Are you tired of seeing the value of your portfolio decline day after day? Or maybe you just need a game plan to automate your investments for 2023. Let's face it, the stock market has been dicey and volatile as of late, so if you're looking for short and long-term guidance, you're in the right place. Hi, and welcome back to our channel. Today, we'll be looking at the top 10 stocks for 2023. These are the stocks that will help to boost your portfolio and set you up for long-term success. And number 1 is a can't-miss opportunity. As the year is already underway and the market is certainly moving, there is no time to waste. So let's get right into it. JP Morgan analysts recently announced their top picks for 2023, noting that the overall market will probably get worse before it gets better. In essence, don't be surprised if the major indexes retest 2022 lows before making a recovery. Still, there are multiple opportunities in our current environment. Let's take a look at the top 10 stocks you should be watching in 2023. Number 10. Xenon Pharmaceuticals. Xenon Pharmaceuticals is a clinical stage biopharmaceutical company committed to developing innovative therapeutics to improve the lives of patients with neurological disorders, including the rare central nervous system or CNS conditions. The Canadian company is focused on the development of novel medicines through the application of their proprietary discovery platform, which they refer to as Extreme Genetics. When analyzing Xenon stock, it's impossible to miss the incredible performance of the stock. In 2022, their stock rose a whopping 26%. For reference, the benchmark for the overall market, the S&P 500, fell nearly 20% last year. In other words, Xenon Pharmaceuticals outperformed the S&P 500 by close to 46%. Xenon CEO Ian Mortimer has outlined plans to increase their momentum in 2023, building on their already strong position in the biopharma space. It's no wonder that analysts are expecting another solid year for the company. Number 9. T-Mobile. Unlike Xenon, many people around the world are already familiar with T-Mobile and their offerings. For those who aren't, T-Mobile is a telecommunications company that houses T-Mobile, Sprint, and Metro by T-Mobile, formerly Metro PCS. T-Mobile stock soared roughly 20% in 2022, and if you remember, with the S&P 500 dropping nearly 20%, T-Mobile is beating the market by around 40%. Amazing! If you watched our previous video, How to Survive a Recession, you might not be all that surprised by T-Mobile's stellar performance. As we discussed in that video, certain sectors of the economy aren't as affected by recessions and high inflation. These sectors include consumer staples, utilities, and healthcare, which makes sense because you're likely to keep your cell phone service regardless of how the economy is doing. Rivaling AT&T and Verizon, T-Mobile has seen a quarterly increase in subscribers in all but one quarter since 2018. That's outpacing AT&T and definitely outpacing Verizon's continuous decline of mobile customers. Verizon lost 189,000 wireless retail postpaid connections in its consumer business in the third quarter of 2022. It was the company's third consecutive quarter of declines in the number of consumer phone customers in its mobile business. It's worth noting that T-Mobile also has a far wider 5G footprint than Verizon. With this in mind, it's easy to see why T-Mobile stock significantly outperformed its rivals in 2022 and is slated to do the same in 2023. Number 8. Target. You might be wondering whether or not Target is considered a consumer staple. Actually, it's considered a consumer discretionary stock, while its rival, Walmart, is a consumer staple. More than half of Walmart's sales are from the grocery category, which is why the company is labeled a consumer staple, which is considered defensive during economic slowdowns as it sells what consumers need over what they want. But with only about 1/5 of Target's sales in the grocery category, Target is considered a consumer discretionary, which is more susceptible to economic slowdowns. This holds up as Walmart stock outperformed Target, which had a dismal year, dropping over 35%. Coming off of its worst year in decades, Wall Street analysts are banking on Target's potential for 2023, hoping that retail will rebound in a major way over the course of the year. Number 7. Microsoft. This is a company known and loved by many. Microsoft has absolutely dominated the market for desktop PCs. This graph shows the global market share held by operating systems for desktop PCs from 2013 to 2022. As you can see, Microsoft, represented by the blue lines, is in a league of its own, maintaining a global market share of more than 80% for the majority of this time period, and even holding on to more than 3/4 of the market today. We know Mac computers are becoming more popular, but in the PC space, it's not even close. Beyond those numbers, Microsoft represents something else that we love in the investing community: diversification. Looking at a breakdown of the company's revenue, we have Microsoft Office, Windows operating system, Xbox Gaming, LinkedIn, and more, all boosted by their enormous cloud services business, Microsoft Azure. Now, they did announce that they'll be cutting 10,000 jobs in 2023, and they certainly aren't the only tech company to announce layoffs. Thousands of organizations have begun reducing their workforce and implementing hiring freezes, as the tech space has been hit extremely hard in this inflationary environment. Although Microsoft and other large tech firms had a rocky 2022 in the stock market, this is an extraordinary opportunity for investors to buy into these positions while they're on sale. When you think of Microsoft, Google, and Apple, understand that while these companies have been hit hard as of late, they each have specific advantages that will hold up their stock price in the long run. This is especially true of Microsoft. They have one of the widest economic moats in today's economy. Honestly, anytime you turn on a computer, you almost expect their Microsoft logo to show up on the screen. And we haven't even begun to talk about their presence in the AI space or their investment in ChatGPT. Yeah, this one's a no-brainer. Moving on to number 6, Las Vegas Sands. Las Vegas Sands Corporation is a casino and resort company that owns and operates resorts, primarily in Asia. Some of its properties include the Venetian Macau Resort and Four Seasons Hotel Macau, and previously the Venetian and Palazzo hotels on the Las Vegas Strip. As a world leader in leisure and business tourism, many analysts suggest that Las Vegas Sands could be poised for its second consecutive year of gains in 2023, after mostly trending downward since the onset of the pandemic. This idea of potential growth is backed by a strong business model, revenue diversification, and expansion initiatives. The company is also confident about its position in Singapore, continuing to invest in the expansion of Marina Bay Sands to support its growth. Additionally, as pandemic-related restrictions ease and travel recovers in Macau, the global tourism company is expecting strong positive cash flows in the coming months. Although the gaming industry has struggled since the pandemic began, and it's still unclear when foot traffic at casinos will return to the pre-pandemic level, the consensus is that Las Vegas Sands stock should rise as China has eased entry for tourists. As we get to number 5, please do us a favor and like the video if any of this information is useful, and be sure to stick with us through the video so you don't miss out on any potential earnings. Number 5, Halliburton. Halliburton is a Texas-based company that is one of the world's largest providers of products and services to the energy industry. With more than 55,000 employees in approximately 70 countries, the company serves the upstream oil and gas industry throughout the life cycle of the reservoir. Halliburton has multiple buy ratings from top analysts, with many indicating an upside of more than 20% in 2023. All of this comes after a year of enormous gains for Halliburton stock. In 2022, its stock price rose over 70%. If past performance is any indication of future success, then it's easy to see why Halliburton is one of the strongest buys in the market today. Number 4, Disney. From Lion King to Toy Story to Aladdin, Disney is another company that we pretty much all know and love, as it's given us some of the greatest performances in entertainment. We didn't love the stock's performance in 2022 though. Tumbling over 40% last year, Disney's primed for a comeback. After quite a bit of drama, longtime CEO Bob Iger, who had stepped down from the position, replaced his supposed successor, Bob Chapek, and reclaimed the position of chief executive. Under his guidance in the short term, Disney is becoming a Wall Street favorite in the media space. Beyond what's expected from Disney Plus, in-person entertainment has come back in a major way. In 2022, the Walt Disney Company generated a total revenue of nearly $29 billion with its parks, experiences, and products segment, an increase of around $12 billion from the year before. Put plainly, when one of the most valuable companies in the world by market cap goes on sale, it doesn't take a rocket scientist to see it as a buying opportunity. Number 3. Charles Schwab. Charles Schwab is a financial services company offering banking, investing, and wealth management services to both retail and institutional clients. Charles Schwab's stock finished last year down 1%, so nearly flat. While that number seems unexciting, the stock actually experienced a lot of action in terms of volatility throughout the year. Their stock was down nearly 30% in mid-June and later rose over 35%. This year, experts are expecting Schwab to grow earnings, which is ultimately what investors are looking for in this market. Additionally, unlike its peers, Schwab's investment portfolio largely consists of treasuries and other securities that hold very little credit risk. Number 2. Bank of America. Staying in the financial services industry, Bank of America is the second largest bank in America. And like many banks, B of A got a boost in the latter portion of 2022 as the Federal Reserve started aggressively hiking interest rates. Having recently reported fourth quarter and year-end earnings, both revenue and earnings exceeded analysts' forecasts. They're also anticipating loan growth in 2023, which, along with rising interest rates, should lead to a boost in net interest income in 2023. Additionally, among the 10 largest banks, Bank of America had the second lowest deposit cost in the third quarter, behind only Wells Fargo. These lower deposit costs also typically translate to higher net interest income. The company's earnings report showed that customers aren't going elsewhere for better interest rates. Add that to their low-risk business profile, and you have a clear case for adding Bank of America to your investment portfolio. Finally, we've arrived at number 1, Amazon. Now, Amazon just had their worst year in decades. The stock fell almost 50% in 2022, but what does this mean? Of course, Amazon is an e-commerce technology company with a footprint in just about every sector of the economy. Some of their main focuses include e-commerce, cloud computing, online advertising, digital streaming, and artificial intelligence. Having been referred to as one of the most influential economic and cultural forces in the world, and one of the world's most valuable brands, Amazon is also the second largest private employer in the US. Amazon's size is almost as impressive as its diversification. Beyond the online shopping platform, Amazon is also responsible for AWS, Prime Video, Alexa, Audible, Twitch, Amazon Music, Kindle, Ring, Amazon Pharmacy, and Whole Foods. While consumers have pulled back spending due to the inflation-induced sell-off, this economic period won't last very long relative to the stock's upside. Analysts are excited at Amazon's potential to achieve faster delivery speed and increased penetration within groceries and the cloud space. If you look at stock market cycles from a bird's eye view, it wouldn't take much convincing for you to see the tremendous opportunity that Amazon is currently presenting. Even on a basic level, Amazon is the world's largest retailer outside of China. Yes, larger than Walmart. This is largely driven by its paid subscription plan, Amazon Prime, which has over 200 million subscribers worldwide. What if I told you that you could purchase this stock of one of the largest and most valuable companies in the world, with 200 million paying subscribers, while the price of that stock is at a 50% discount? Oh, and with the knowledge that the stock market will indeed rebound. Does that sound like a good deal to you? It does to us. If you take nothing else from this video, it's important to understand that sell-offs present opportunity. This is when wealthy investors double down on their investments and the rich get richer. Remember, success leaves clues. Thus, if you want similar results, it's imperative that you take similar action. Don't sit on the sidelines this year. Your future self will thank you. If you learned something from this video, drop a comment down below and let us know which stock surprised you the most, or which one you're most likely to add to your portfolio. Thanks again for watching, and we'll see you next time.